Forget the S&P 500. Ignore the Dow. If you want to know the truth about the global economy right now, look at the only chart that isn't lying. We are witnessing a historic break in the system. Gold didn't just hit a new high today. It shattered reality, crossing $4,600 an ounce. And while everyone was watching gold, silver quietly turned into a monster, surging past $84. Make no mistake, this isn't inflation. This isn't a bubble. This is panic. Money isn't just walking to safety, it is running for its life. Why? Because three massive crises have just collided at the exact same moment. A Middle East on the brink of war, a U.S. economy hitting the brakes, and an unprecedented civil war in Washington between Donald Trump and the Federal Reserve. The system is blinking red, and today we explain why. Let's start with the first pillar of this rally: geopolitics. The situation in the Middle East has moved from tense to critical. The crisis in Iran is unfolding rapidly, and it is no longer contained to the streets of Tehran. It is spilling over into global capitals and, consequently, into your portfolio. We are seeing deadly protests on the ground in Iran. The internal stability of a major regional power is shaking, but markets don't usually panic over internal protests alone. The panic comes from the external reaction. Washington is fueling the fire. Donald Trump has threatened strong action against Iran. For the markets, this rhetoric is a massive red flag. It signals risk. The fear is not just about regime change, it is about a wider regional conflict. If the U.S. takes strong action, does Iran retaliate? Do shipping lanes close? Does oil spike? When geopolitical risk rises to this level, investors abandon paper assets. Paper assets depend on peace, treaties, and functioning governments. Gold does not. Investors are moving aggressively into assets that hold value regardless of who is in power or whose missiles are flying. They are hedging against a scenario where the Middle East conflict spirals out of control, disrupting global energy supplies and dragging superpowers into a kinetic confrontation. This uncertainty is the first engine driving gold to $4,600. It is the premium you pay for insurance against war. But while the Middle East is burning, the real explosion is happening right here in Washington, D.C. This brings us to the single most dangerous driver of this rally: the war on the Fed. For decades, the global financial system rested on one sacred pillar: Federal Reserve independence, the idea that interest rates are set by data, not by politicians. That pillar just collapsed. Today, Fed Chair Jerome Powell dropped a bombshell that shattered institutional trust. He revealed that the Trump administration isn't just applying pressure. They are threatening a criminal probe against the central bank. Let that sink in. The president is threatening the bankers with jail time if they don't bend the knee. This is no longer monetary policy. This is a hostage situation. For investors, this is a nightmare. If the Fed is forced to print money or cut rates to avoid prosecution, the U.S. dollar ceases to be a currency. It becomes a political tool. The market knows this. Investors are dumping the dollar because it now carries political risk. They are fleeing to gold and silver for one simple reason: gold cannot be subpoenaed. Silver cannot be intimidated by a criminal investigation. It is the ultimate vote of no confidence in the management of the U.S. dollar. The third pillar of this rally is the U.S. economy itself. Even without the war in Iran or the political war in Washington, the economic fundamentals are flashing warnings. The U.S. economy is showing undeniable signs of slowing down. The engine is sputtering. Job growth has cooled significantly, signaling that the labor market is cracking. Why does this matter for gold and silver? Because a slowing economy forces the hand of the Federal Reserve. Markets now expect at least 2 interest rate cuts this year. This is basic economics, but it is powerful. Gold and silver are non-yielding assets. They don't pay you interest to hold them. When interest rates are high, money flows into bonds and savings accounts. But when the economy slows and rates fall, money becomes cheaper. The opportunity cost of holding gold drops. So, we have a perfect storm. We have a slowing economy that requires lower rates. Lower rates make the dollar weaker and gold more attractive. But here is the catch. Usually, the Fed cuts rates calmly to support a soft landing. But now, with the political pressure we just discussed, the market fears the Fed will cut rates, not because it's the right thing to do, but because they are being forced to. That smells like inflation. That smells like currency debasement. So, today's rally is the result of these three forces colliding. Geopolitical risk from Iran, the uncertain future of the Federal Reserve's independence, and the expectation of cheaper money due to a slowing economy. To really understand $4,600 gold, we have to stop looking at it as just a commodity. We need to look at history. Gold and silver have always done more than just track inflation. They act as the barometers of world peace. They don't predict war, but they measure fear. And right now, the fear index is off the charts. Look at the historical pattern. It is undeniable. In the 1970s, the world was shaken by oil shocks and the Cold War. What happened? Gold prices doubled after the 1973 oil embargo. In 1979, during the Iranian Revolution, echoing what we are seeing today, gold surged again. In the 1980s, amid the Soviet Union's invasion of Afghanistan, gold hit a then-record high of $850 an ounce. Silver exploded even more violently. Move forward to 1990. Iraq invades Kuwait. Gold jumps within weeks. After 9/11s, gold began a decade-long bull run, driven by the war on terror, massive government spending, and global instability, taking it from $250 to nearly $1,900 by 2011. And again in 2020, when the pandemic shut down the world, gold rushed to new highs. Why does this keep happening? The answer is simple. Gold is neutral. It does not belong to any government. It is the only financial asset that is not someone else's liability. It cannot be printed by a central bank. It cannot be sanctioned by a foreign policy decision. When trust in institutions falls, whether that institution is the White House, the Fed, or international treaties, trust in gold rises. We are currently living through a period where trust in all these institutions is hitting rock bottom simultaneously. Now I want to pivot to silver, because while gold is the headline, silver is the story that smart money is watching. Silver at $84 an ounce tells a slightly different, and perhaps more urgent story. Silver is a unique beast. Like gold, it is a safe haven asset, but unlike gold, it is a critical industrial metal. You cannot build the modern world without silver. It is in electric vehicles. It is in solar panels. It is in the defense technology and guidance systems of the very missiles that might be used in the Middle East. When silver rallies alongside gold, as it is doing now, it is a signal of something deeper than just short-term fear. It signals expectations of a longer period of global stress and supply chain fragmentation. We have to place this in the context of the silent economic war between the US and China. China dominates the processing and supply chains for many critical metals. As the US economy slows and political chaos ensues, there is a fear that industrial supply chains could be weaponized or disrupted. Silver at $84 reflects a potential shortage. If the world is moving toward a conflict economy, building more defense tech, more independent energy grids, demand for silver skyrockets. But if the mining supply is disrupted by geopolitical tension, or if countries like China start hoarding strategic metals, which they are, the price has nowhere to go but up. The market is realizing that silver is undervalued relative to its strategic importance. The paper market for silver has suppressed the price for years, but with physical demand rising from both investors scared of the Fed and industries scared of supply chain collapse. The dam is breaking. This is why many experts call gold and silver the most reliable indicators in the market. They are flashing a warning that trust is shaking, risks are rising, and the world is bracing for turbulence that paper, money cannot fix. So what is the takeaway from this historic market move? The surge to $4,600 gold and $84 silver is not a fluke. It is a rational reaction to an irrational world. We are seeing the convergence of a kinetic crisis in the Middle East, a constitutional crisis in the U.S. banking system, and a structural slowdown in the U.S. economy. The threat of a criminal probe into the Federal Reserve is the catalyst that changes everything. It tells the world that the U.S. dollar is no longer above the fray of partisan politics. It tells foreign nations and domestic investors that the rules of the game are changing. And when the rules change, you don't want to be holding the assets that depend on those rules. You want to hold the assets that wrote the rules of value for the last 5,000 years. Long story short, when gold and silver hit records like this, they aren't just making headlines. They are issuing a warning. The trust in the system is eroding. The triple threat of geopolitics, Fed politicization, and recession is here. The world doesn't fit into neat boxes anymore. the lines between economics and war, between politics and finance, are gone. And as long as Washington fights with the Fed, and tension rises in Tehran, the path of least resistance for gold and silver is higher. This is the new reality. Adjust your expectations accordingly. January 7, 2026, a date that was supposed to be the funeral of silver. The CME Group, in a desperate attempt to protect the massive short positions of the world's largest bullion banks, hiked silver margin requirements by a staggering 47% overnight. In any normal market, this blow would have sent prices into a tailspin. They, the architects of the fiat system, expected a bloodbath. They expected you to panic. They expected the paper wall to hold and the price to retreat back to the safety of $30. But then, something impossible happened. Instead of crashing, the market absorbed every single ounce of selling pressure within just 4 hours. By January 9th, silver didn't just recover, it exploded, piercing through the $5 per ounce mark like a hot knife through butter. The shorts weren't just squeezed to the point of suffocation, they were incinerated. Welcome to January 13th, 2026. We are no longer living in the era of cheap silver or managed markets. We are witnessing the birth of the silver supercycle, a geopolitical black swan event that is currently dismantling the more dominance of the US dollar. While the mainstream media talks about market volatility, the smart money is looking at the scoreboard. China has shut the gates, Russia has weaponized the mines, and the Federal Reserve is staring into an empty vault. Today, we dive into the forensic evidence of why silver is no longer just a metal. It is the ultimate weapon in a global financial war that has just turned hot. Let's recap the chaos of the last 14 days. On January 1, 2026, as the world celebrated the new year, Beijing quietly dropped a financial nuclear bomb. The Chinese Ministry of Commerce officially reclassified silver as a Tier 1 national strategic material. This isn't just a label, it came with a total export ban on unrefined silver and a dual license requirement that effectively cuts off Western tech giants from the world's largest refining hub. Simultaneously, the emerging bloc of nations confirmed the final architecture of their new common currency, the unit. For those who haven't been following our recent reports, the unit is the new trade currency designed to bypass the old payment systems and the core of its value. It's not faith and credit. It's a basket of commodities where silver holds a weight of up to 60% relative to its actual market scale. In the West, the manipulation scripts are failing. For decades, the gold-to-silver ratio was suppressed, hovering near 81 or even 101. But as of this week, that ratio has collapsed below 41 and is heading straight toward the single digits. We are seeing a contagion of physical demand that paper contracts can no longer satisfy. Inventories at major vaults are at their lowest levels since the 1970s, and for the first time in history, the physical silver price in Shanghai is nearly 15% higher than the paper price in London. To understand why this spring is uncoiling so violently, we have to look at the three-pronged attack currently hitting the old financial system. First, the byproduct trap. Most people think if the price of silver goes to $500, miners will just dig more. They are wrong. 70% of silver is a byproduct of mining copper, zinc, and lead. If you are a copper miner in Chile and the price of silver moons, you don't magically produce more silver. You are limited by your copper output. As Russia, a top producer of these metals, begins to restrict exports for strategic reasons, the silver supply is being politically throttled. We are entering a supply vacuum where no amount of printed money can manifest a single ounce of metal. Second, the solid-state revolution. Solid-state battery technology has officially moved into mass production in 2026. These batteries are a revolution for electric vehicles, charging in minutes and lasting 900 kilometers. But they require double the amount of silver compared to traditional batteries. Recent reports suggest that tech industry demand alone is projected to consume the entirety of global silver production by the end of this year. This leaves zero for solar panels, zero for medical equipment, and zero for private investment. Third, remonetization and the parabola. Silver has long been the thermometer for currency debasement. Looking at the current technical charts, we are only in the early stages of the rally. Historically, the gold-to-silver ratio always returns to its natural equilibrium of 15:1. If gold is trading at $3,500, A 15:1 ratio puts silver at $233. However, in-depth projections suggest a violent overshoot toward 9/1. At that point, a target price would be $3,500 divided by 9, which is approximately $388 per ounce. In a global liquidity squeeze, prices don't move linearly. They teleport. We are looking at a scenario where silver could hit 4 digits before the end of the 2026 fiscal year. The greatest danger to you is not the price going down, but your own psychology. Most people will see silver hit $150, think they've won, and rush to sell. They will exit their positions right before the true explosion, the phase that generates up to 50% of the total profit in just the final few weeks. As of January 13, 2026, the silver train has officially broken all barriers. The combination of China's export controls, the new Eastern currency, and the tech industry's hunger has created a perfect storm. The Western central banking system is trapped. If they raise interest rates to save the currency, they collapse the banks. If they print money to save the banks, they send silver to $2,000. There is no soft landing left, so I ask you, when the dust settles and the paper games are over, what will you be holding? Will you hold digital balances that can be frozen or devalued, or will you hold the physical asset that the East is prioritizing as its very lifeblood? The markets are offering you one final gift through these short-term corrections. Don't wait for the mainstream news to confirm a bull market, because by then, the price you pay will have an extra zero at the end of it. The clock is ticking. Stay sharp, update your data, and ensure you have the strongest possible position. January 14, 2026. While the mainstream media spent the morning obsessing over celebrity scandals and political bickering in Washington, a silent, lethal strike was delivered to the heart of the Western financial system. It didn't happen with a missile or a cyber attack. It happened in the quiet, sterile trading rooms of the London Bullion Market Association and on the digital ledgers of the COMEX. As of this moment, we are no longer in a bull market. We are in a state of financial siege. 2 days ago, on January 12, 2026, Reuters broke a story that should have sent every person on Earth running to their local coin shop. Gold and silver didn't just rise. They notched record highs in a vertical move that defied every algorithmic prediction on Wall Street. Gold smashed through the psychological barrier of $4,500, but that was just the smoke. The fire, the real white-hot destruction, is happening in the silver market. The headline from Reuters was polite. Gold-silver notch record highs on safe haven demand, Fed rate cut bets. But if you know how to read between the lines, if you understand the language of those who actually move the world's capital, that headline translates to, the exit doors are locked, the building is on fire, and the global elites are the only ones with a key to the roof. Why is the most manipulated, suppressed, and undervalued metal in human history suddenly behaving like a penny stock on steroids? Because the great silver trap has finally been sprung. The Federal Reserve, trapped between a collapsing banking system and runaway inflation, has signaled a desperate pivot to rate cuts. But in doing so, they've handed China and Russia the perfect weapon to deconstruct the US dollar. Tonight, we aren't just looking at a price chart. We are conducting a forensic investigation into the end of the paper age. This is the moment the physical reality of the world finally breaks the digital illusion of the banks. The era of cheap, abundant silver is dead. The era of the American financial hegemony is on life support. This is not a drill. This is the funeral of the petrodollar, choreographed by Beijing and executed with the very metal that sits in your smartphone, your electric car, and your missile guidance systems. Let's reconstruct the crime scene using the facts provided by Reuters and the internal data leaking out of the East. On January 12, 2026, a perfect storm hit the commodities sector. First, the Federal Reserve. For the past 2 years, the Fed has tried to play the tough guy, keeping interest rates high to fight the inflation they created. But by late 2025, the cracks became canyons. The U.S. regional banking sector began to bleed out, unable to sustain the weight of high interest rates on their devalued bond portfolios. The Fed had a choice: let the banks fail or destroy the dollar. They chose the latter. The market began betting heavily on immediate, aggressive rate cuts for the first quarter of 2026. Second, the safe haven surge. When the central banks pivot in a high inflation environment, those in the know flee from yieldless currency into hard assets. Reuters noted that this demand was particularly explosive in India and China, in Mumbai. The premium for physical silver bars hit an unthinkable 15% over the London spot price. People weren't just buying silver, they were hoarding it as if their lives depended on it. Third, and most importantly, the geopolitical counterstrike. While the U.S. was busy celebrating the new year, Beijing quietly implemented the Strategic Mineral Security Act on January 1, 2026. This act essentially placed a chokehold on the export of refined silver and silver-based components, since China controls over 50% of the world's silver refining capacity. They didn't just raise the price. They removed the supply. By the time the markets opened on Monday, January 12, there was no liquidity left. The massive, hidden buy orders from sovereign wealth funds had already sucked the vaults dry. What we saw was a liquidity squeeze of biblical proportions. Silver didn't just go up, it gapped up, leaving short sellers, hedge funds, and bullion banks in a state of absolute panic. To understand why this is happening, we have to look at the short squeeze mechanics. For decades, the price of silver has been a fiction. It has been suppressed by a paper-to-physical ratio that, at times, exceeded 400 to 1. This means for every 1 ounce of real, physical silver in a vault, banks sold 400 ounces of digital silver to investors. It worked as long as nobody asked for their metal. But in early 2026, the world asked for its metal, the Chinese silver bullet strategy. China is playing a game of 4D chess while the West is playing checkers. For years, the U.S. has used the dollar and the SWIFT system as a weapon, sanctioning anyone who didn't fall in line. Beijing realized that the U.S. Achilles heel isn't its military, it's its total dependence on foreign supply chains for the Green Revolution. Every electric vehicle requires roughly 1 ounce of silver. Every solar panel, every 5G tower, every sophisticated missile guidance system requires silver. By banning the export of refined silver, China has effectively deindustrialized the U.S. green energy transition overnight. They have turned silver from a commodity into a geopolitical hostage. Think about the irony. The U.S. government wants net zero by 2030, but to get to net zero, you need silver. And to get silver, you now have to go through Beijing, who is only accepting payment in gold yuan or specialized hard asset trade units. The Reuters report mentions safe haven demand. But what they aren't telling you is that this is a resource war. The Fed's suicide mission. Now, let's look at the Fed. Jerome Powell is in a checkmate position. If he keeps rates high, the U.S. government can't afford the interest on its $35 trillion debt, and the banks collapse. If he cuts rates, as the Reuters report suggests the market expects, the dollar becomes a hot potato. When interest rates drop, the opportunity cost of holding silver disappears. In a world where the dollar is losing 10–15% of its purchasing power annually, a 0% yield on silver is infinitely better than a 4% yield on a dying currency. The institutional titans, the sovereign wealth funds of Norway, the UAE, and Singapore, have realized this. They are dumping their U.S. treasuries and buying anything that can't be printed. What we are seeing is a death spiral for the dollar. The more the Fed cuts, the higher silver goes. The higher silver goes, the more expensive it becomes for the U.S. to build the technology of the future. The more expensive tech becomes, the more inflation rises. It's a loop that only ends one way, with the total reset of the monetary system. The short panic of the bullion banks. We also need to discuss the commercial shorts. Banks like JP Morgan and HSBC have historically held massive short positions on silver to manage the price. In 2025, they were caught off guard by the sheer volume of Eastern demand. On January 12, as the price surged to record highs, these banks faced margin calls in the billions. To cover their losses, they were forced to buy silver back at any price, which only pushed the price higher. This is the liquidity squeeze in action. We are witnessing the largest transfer of wealth in history, as the paper wealth of the West is liquidated to pay for the physical assets of the East. The most dangerous part of this story isn't the price on a screen, it's the physical deficit. For 5 years, the world has used more silver than it has mined. We have been living off the dregs of old stockpiles, but those stockpiles are gone. In the West, we treated silver like a byproduct of lead and zinc mining. In the East, they treated it like strategic fuel. As we move deeper into 2026, we are seeing force majeure events. Mining companies in Mexico and Peru are reportedly being encouraged by Chinese-backed interests to slow-walk deliveries to Western exchanges. If you are an American manufacturer, say an aerospace company building satellites, you are now facing a stockout scenario. This is where the thriller becomes reality. Imagine a world where Boeing or Lockheed Martin cannot fulfill a defense contract because they cannot source 500 pounds of high-grade silver. Imagine a world where Apple has to delay the next iPhone not because of a chip shortage, but because the conductive paste used in the circuitry is being rationed by the Chinese government. This is resource nationalism at its peak. The Reuters report touched on the safe haven aspect, but the industrial panic is what will drive silver to $100 and beyond. We are no longer debating if silver is undervalued. We are witnessing the market frantically trying to price in the extinction of available supply. The massive technology firms of Silicon Valley are now in a panic. For years, they ignored the commodity markets, assuming the supply chain would always be there. Now they are realizing that the cloud is built on a foundation of silver, and that foundation is cracking. We are hearing reports of tech giants attempting to buy entire silver mines in Nevada and Idaho just to secure their 2027 production lines. But it's too little, too late. The architects of this crisis, the ones who controlled the supply in the East, saw this coming years ago. If you look at the volume of the silver trades on January 12th, you see a very specific pattern. It wasn't retail fear, it was systematic large block purchasing. These are orders placed by entities that don't care about the price, they care about the delivery. Since December 2025, the registered silver stocks, the metal actually available for delivery on the COMEX, have dropped to levels not seen since the 1990s. We are days, perhaps weeks, away from a default into cash. This is the nightmare scenario for the Western financial system. It's when the exchange tells a buyer, "We know you bought silver, but we don't have it. Here is some paper money instead." But when the paper money is losing value every hour, no one wants the cash, they want the metal. When the COMEX defaults into cash, the price discovery mechanism of the West is dead. The price will then be set by the Shanghai Gold Exchange, and they aren't interested in helping the US dollar survive. The global financial architects, the ones who manage the world's largest pension funds and insurance pools, are now realizing that the paper silver they have on their balance sheets is worthless. They are all rushing for the same small exit at the same time. This is why the Reuters report mentioned record highs for both gold and silver. They are moving in tandem because they are both parts of the same life raft. But silver is different. Gold is mostly hoarded in vaults. Silver is consumed. Once it's in a solar panel or a cruise missile, it's gone. You can just recirculate it. The industrial demand is a one-way street, and the street just hit a dead end. The U.S. Treasury is now in a state of emergency. If they can't stabilize the silver price, they can't stabilize the technology sector. If they can't stabilize the tech sector, the stock market collapses. If the stock market collapses, the U.S. government loses its tax base. It's a house of cards, and the wind from the east is blowing harder than ever. We cannot talk about the Reuters report without talking about the BRICS Plus alliance. For the last 18 months, Russia and China have been working on a unit of trade, a currency backed 40% by gold and 60% by a basket of commodities, including silver. By driving the price of silver to record highs, they are effectively revaluing their new currency while devaluing the US dollar. Every dollar that the Fed prints to save the US banks makes the BRICS currency stronger by comparison. It's a masterclass in economic warfare. Russia, for its part, has recently added silver to its state reserves for the first time in decades. They know what's coming. They know that in a world of digital sanctions, the only thing that matters is what you can physically hold and what you can physically trade. The West thought they could win with software and finance. The East is winning with hardware and elements. The Reuters report mentions Fed rate cut bets, but what it doesn't mention is that the Fed is no longer the most important bank in the world. The People's Bank of China and the Central Bank of Russia are now the ones setting the tempo. They are the ones who decided that January 2026 would be the month the West realized it was bankrupt. While the Reuters article focuses on general safe haven demand, we need to look at the insiders. These are the individuals and entities that have spent the last decade preparing for this exact moment. We aren't talking about small-time investors. We are talking about the family offices of the ultra-wealthy, the sovereign funds of resource-rich nations, and the massive industrial conglomerates that need silver to survive. They aren't buying 10 ounces or 100 ounces. They are buying by the ton. They are using what are known as dark pools to acquire physical metal without alerting the public. They know that once the man on the street realizes what's happening, the price will already be in the hundreds. By the time you see the silver record high headline on your phone, the insiders have already filled their vaults. The institutional giants have abandoned the 60/40ths portfolio of stocks and bonds. They are moving toward a hard asset model. They are buying land, they are buying energy, and they are buying silver. They are preparing for a world where the US dollar is just another failed fiat currency in the dustbin of history. So what is the climax of this story? The record highs of January 12, 2026 were not the peak, they were the breakout. We have spent 40 years in a bull market for silver, and we are now entering the scream phase. The Reuters report gave us the what. I have tried to give you the why. The Fed is trapped and will sacrifice the dollar to save the banks. China and Russia have weaponized silver to cripple Western industry and back their own new currency. The paper silver market is being exposed as a massive, multi-decade fraud. The industrial world is facing a stockout that will halt the green energy transition and military production. The global elites have already left the building. They moved into gold at $2,000, and they moved into silver at $25. Now, as the price rockets toward triple digits, the retail crowd is finally waking up. But by the time the average person realizes they need silver, it won't be expensive, it will be unavailable. The final warning. Do not be distracted by the daily dips or the volatility. The banks will use every trick in the book, fake sell-offs, media hit pieces, and margin hikes to get you to drop your physical metal. They need your silver to cover their shorts. They need your real assets to pay for their fake debts. The question you have to ask yourself tonight is simple. In a world of digital lies and printed trillions, what is the weight of the truth in your hand? We are moving into a bipolar financial world. The West has the printing presses, the East has the metals. History is very clear about which side wins that battle every single time. Keep your eyes on the volume, watch the COMEX delivery reports, and most importantly, watch what the big players do, not what they say. They are telling you exactly where the ship is headed. We don't just report the news, we investigate the forces that create it. Stay sharp, stay liquid, and stay out of the trap. What's your move? Are you holding the metal or are you holding the bag? Leave a comment below, let's discuss the silver trap. And if you want to follow the real flow of capital through this chaos, make sure you're subscribed. This is a financial thriller, and we are only in the second act.